My name is Mary Pearl Opari Ado, and I'm your tutor for corporate financial analysis. So, in earlier sessions, we discussed that there were various tools that can be used to analyze financial information. In previous sessions, we discussed the financial ratio analysis and also the cash flow analysis. In this particular session, we are going to talk about the comparative financial analysis as part of the analysis of the statement of financial position and income statement. So by the end of this session, you should be able to conduct comparative analysis of financial statements and also explain the advantages and disadvantages of using this type of analysis. Made mention that analysis is not done in a vacuum. Hence, it's necessary to make comparison whenever you are undertaking analysis. Now, the kind of comparison you do can be done in various ways. Either you are comparing between different companies in the same industry, or you are comparing against industry averages, or you are comparing different years of the same company. Now, in this session, we'll demonstrate how comparative analysis is done. So in situations where you have to compare elements of the financial condition from one year to another in absolute terms as well as in percentages, then that recasted statements that you make for that comparison is known as the comparative financial statement. Now, this kind of financial statement is designed in order to provide a view of the performance or elements of the financial statements in different or varying times. So you can have a comparative financial statement for a particular company between a number of years. Now, this statement is made by showing the absolute money values of each element in the income statement as well as the statement of financial position for different periods. So you can have, let's say, between the period of 2015 to 2023, and you'd have the monetary values of each element in the income statement and the statement of financial position. So let's take, for the statement of financial position, you have the absolute money values of all your current assets, all your current liabilities, all your non-current assets and liabilities, as well as equity. And now you can show the increasing or decreasing absolute money value of each element, and that is done by just finding the difference between the current period and the previous period. So let's say for inventory, which is an element in the statement of financial position, and it's also a current asset. They take inventory for 2015-16 down to 2022, and then you find the increase or decrease from year to year. So you find the difference from 2015, 2016, 16 and 17, 18, 19 in that regard. And now you show the increasing or decreasing value in terms of percentages. So you could say between 2015 to 2016, inventory increased by 20%. Between 2016 to 2017, inventory increased by, say, 25%, in that order. So if the percentage is calculated by the increasing or decreasing amount divided by the amount in past period times 100. So the difference, let's take 2015 and 2016. So you find the difference between 2015 and 2016. So you subtract the 2016 figure from the 2015 figure. That value you get, that's the difference. You divide it by the past period amount. So the difference divided by the amount of that particular inventory in 2015 multiplied by 100, and that would be the percentage. Now, what is the advantages of performing a comparative analysis? Now, you realize that when you do comparative analysis, it is possible for you to compare two or more periods in the sense that you're able to place them side by side in order to facilitate comparison. in a horizontal manner. So you can do this within a firm or between or amongst firms. And also it brings out more clearly the nature and trend of current changes that affects the enterprise. So if you know sales, if you do that comparative analysis for sales, you can determine the trend of the changes in sales, whether your sales has been increasing over the past periods, or whether you've had constant sales or decreasing sales, and that will help you to make or to make strategic plans when it comes to your sales. Now it also helps in estimating weaknesses in the operating cycle, in financial health, and also the future position of the business. So you realize that by doing this comparative analysis, you're able to identify any loopholes in your business cycle, and you can also know if the position of your firm is strong enough. And that will help you to determine this, whether your firm will be growing or is stagnating, or whether it has potential to survive in the near future. So if you realize your sales has been declining over the past periods, and you know exactly by how much percentage and the difference in sales revenue you've made in the past years, it will help you to make more informed decisions as a business. Now, what the one disadvantage of comparative is that it may be misleading. Example, or in cases where you've had frequent changes in your accounting principles and procedures over the period of time. So the consistency concepts advises or urges that we should maintain the same accounting principles and procedures over some period of time. In that case, it would help you to make comparative analysis very easier. And also, proper comparison between two firms is not possible because there is no common base for comparison due to differences or in firm differences. And also, comparative analysis does not show the relation of any item in terms of another, especially when it comes to the income statement. It doesn't show the relation of any of the items to net sales, and also in relation to the statement of financial position, it doesn't show any relation to total assets or total liabilities, and that is one shortcoming of comparative analysis. So in this session, we discussed comparative analysis of the statement of financial position and also the income statements. We discussed the process of comparing year-on-year values and also the advantages and disadvantages of using the comparative analysis. Thank you.